Another day and another fall. Rupee is spiraling toward 80 versus the dollar at a breakneck speed. The rupee depreciated by 22 paise to close at a fresh lifetime low of 79.48 against the US dollar today. That amid subdued domestic equities. However, receding crude oil prices in the international market restricted the rupee's loss. While the rupee has fared better than other emerging market currencies, the Indian currency has tumbled nearly 7% this year against the dollar. One factor that has triggered this free fall is the massive sell-off by foreign portfolio investors. So far in 2022, FPIs have dumped Indian equities worth over $29 billion. After staying weak for the better part of the day, benchmark indices recouped most of their losses to close on a flat note. Market snapped three-day winning run. Sensex closed at 54,395 down, nearly 87 points lower. Nifty was able to hold on to the 16,200 mark. Nifty IT dragged the market lower following TCS earnings. The IT slid 3%. TCS, Infosys, HCL Tech were among the top laggards. Bharti Airtel was the top Nifty loser after Adani's 5G spectrum bid. On the other hand, the blue chip gainers included the likes of Eicher Motors, ONGC, Tata Steel, Dr. Reddy's and Mahindra & Mahindra. Now our global business editor Udayan Mukherjee joins us. Udayan, the market has been volatile for quite some time now, but is this pullback going to continue in the near future? What do you think?
Well, the market seemed quite stable enough today, and while there was a dip earlier in the trading session, it managed to claw back from that, particularly the broader market. If you look at the mid-cap index, it spent most of the day in the green. This is a sign of a market which seems to be reluctant to go down immediately, because we've had almost a 1,000-point rally on the Nifty, which is not insignificant from its recent lows of 15,200. But even at this level of 16,000 plus, it has these dips and the dips get bought into. So somehow looking at the screen, it has the appearance of a market which is not quite done with its pullback yet. Difficult to say how long this pullback will continue, but it still seems to be in that pullback mode. And it's all the more commendable because today we had a couple of heavyweight names like TCS and Bharti which were under the hammer. The market clearly was a little disappointed with the TCS earnings because of the margin compression, the tepidity of growth in the order book. So both from a growth and from a margin point of view, it probably fell short of street expectations, and that's a heavyweight stock which was under pressure. The other, of course, was Bharti, where coming fresh off the recent examples of the cement sector's underperformance post Adani's entry, the very mention of Adani bidding for 5G spectrum saw Bharti take a bit of a tumble. The market clearly has some kind of concerns on that front. But despite these two heavyweights not doing well, we saw the Nifty actually fighting back quite well, and the broader market, despite the weight of technology dragging it today, did quite well. So I think we are in stable ground right now, still not out of the woods by a long shot, but maybe the pullback which started around 15,200 is not quite done yet, and the market is probably trying to complete that period of respite. And with me is our special guest for the day, Shyam Sekhar, founder of iThought Advisory and a veteran of many decades for the stock market. Shyam, it's very good to have you on the show. Let me begin by asking you a general question. We've had a 1,000-point pullback in the Nifty from the recent lows. How are you reading this period of respite for the market?
I think the markets are just recovering from a one-way movement which we saw in May and some part of June. I believe that what we had factored in before the Ukraine war and what we see now, there is a gap, and I think the markets will have to fill that gap sooner than later. But as you know, markets will always be non-linear in changing its stance also. So it went one way down, it's again going up. Probably somewhere it's again going to realize that the valuations may not justify where we are, and it may again take another direction sometime soon. But for the moment, I think this is more kind of a reaction to the sustained fall that we saw in May and a good part of June.
So you think this volatility will be with us for some more months to come? I mean, what's your sense of how much deeper the cuts could be before we are done with this ordeal? You sounded quite circumspect about valuations and whether we have seen or made a final bottom already?
Well, I think that the valuations will need to adapt to the emerging scenario, which means that volatility will be there for some more time to come. We also have numerous policy responses by various countries to the inflationary problem. The stock markets will naturally react to every single policy response. Like when you saw the export duty on metals, the stock market took a very nasty fall subsequently. Similarly, whenever you see bad news coming on inflation from the West, we will wake up to a rattled stock market. So it's not going to be easy times at all. It's going to be very difficult to predict, and volatility is a given for the imminent months to come.
Okay, we'll talk about the macro triggers in greater detail, but first tell me, how are you approaching this period, this uncertain period, from a portfolio construction point of view? What kind of stocks are you including to ride out this phase? What kind of stocks are you setting aside as the ones that you would not like to touch?
Firstly, I think that the portfolio that we are building now will have to deliver over an extended period of time. The way I look at it is that the markets are going to continuously react to near-term trends and expectations for some more time. So this is a good time to be bottom up, to be very specific on stocks and sectors which we like for a holding period of 3 to 5 years, and to align our portfolio to buy such stocks. Let me give a parallel. In 2010 also, post the GFC, we had this kind of a volatile phase, and you're very familiar with that. During that phase, what I did was to look at businesses beyond the immediate 1 or 2 years, and we bought businesses which we felt will do well over extended periods of time. So we did not have to bother about the immediate reaction of the market to the stocks. Just stick to the bottom-up approach, look at individual companies, identify companies which will grow for an extended period of time, look if the sectors are reasonably stable and whether we could expect that stability to sustain for a longer duration of time. And based on that, construct portfolio of such companies. So we did not have to worry too much about the near-term trends in the macro. So we were able to put the macro aside and focus on companies and their fundamentals and the relative attractiveness of companies for the longer term. So that basically helped us to build a portfolio and at the same time manage the macro volatility by sidestepping it. So that is precisely what I would do now as well for the next year or two. Be very company specific, be very sector specific, be bottom up, and bet on companies which will do well once this volatility settles and once the macro headwinds are behind us. That would be the broad approach.
Can you illustrate this strategy with just one example, Shyam, from what you've been doing in recent times, an example of a company which may be volatile over the next 1 year in terms of a stock price, but one that you are confident about in the next 3 to 4 year kind of a time frame, where wherever the stock bottoms out, eventually it will generate returns. I mean, that will help our viewers understand what you're talking about.
See, a very obvious example could be a large cap company like a HDFC or a Larsen & Toubro, which are going through a little bit of, negative sentiment at this point in time. But these are companies which are very, very strong. Fundamentally, they are very, very material to our economy. They are capable of giving us sustained growth over longer periods of time. The markets are not liking them in the near term. Typically, when you look at these companies, when they are trading either lower than their historic valuation multiples or not factoring in the changes which the company has done over the recent years to make themselves less levered and better equipped for growth, we are going to get these companies at valuations which we normally don't. So typically, I would buy businesses like that, which would stand their ground and deliver superior returns when the economy goes back to growth, and these companies are able to participate significantly and materially in the growth.
Do you find such companies today in the mid-cap and small-cap universe as well, or is there a distinct large-cap bias because of the uncertainty and the volatility in the environment?
No, it is possible to identify companies in every space. For example, in the mid and small-cap space, I would think that companies which are in the industrial goods space are likely to do extremely well for extended periods of time. You are very well aware of the kind of infra investments that we are seeing over the last 2 years, and there is visibility of such investments happening for the next 2 to 3 years as well. Given such visibility, and given the fact that the cap good cycle will also slowly start and gain momentum, given that we see already that order books of many of these companies are at 3 or 5 year highs, most of these companies which are in the industrial goods space, be it in welding, in refractories, in motors, in transformers, all of these companies in the small and mid-cap space should be very, very interesting to look at. That is my sense.
And you can watch this whole interview on Business Today and on our YouTube channels as well. Time for a quick commercial break, but stay tuned. I'll be right back in a short while.
Australia has killed millions of bees to save honey production. Killing bees sounds a bit too much, right? But it was done to prevent a parasitic plague that kills bees. It can even wipe out an entire colony of them. The outbreak of the deadly varroa mite poses a massive threat to Australia's multi-million-dollar honey industry. The varroa is a parasitic insect that attacks and feeds on honeybees. These tiny pests are reddish-brown in color, and they travel from bee to bee and also through beekeeping equipment. Experts have blamed the sharp decline of bees for the spread of this deadly mite across the world. These mites live and feed off on adult honeybees, but they mainly feed and reproduce on larvae and pupae in the developing brood. This weakens the honeybees and causes malformation. The mites also make the honeybees sick, transmitting numerous viruses. The entire bee colony gets infested with the mite, which impairs their ability to fly or work. Eventually, they die earlier than they are supposed to. So colonies of honeybees in Australia have been put under lockdown to limit the outbreak. The first outbreak of this kind was spotted near Sydney. Death rates among honeybee colonies have been a concern for decades around the world. Their death is attributed to a range of issues like climate change and exposure to parasites. The latest lockdown could have an adverse impact on several crops in Australia, like almonds, blueberries, and more. These crops are dependent on hives for pollination. This comes at a time when Australia is going through a tough time dealing with energy price rise due to the Russia-Ukraine war. And the country is also facing supply chain issues because of bushfires, flood, and a mouse plague.
You are watching.
Welcome back. Let's bring you some other business stories as well. IT bellwether TCS has reported a weak set of numbers this quarter. While the revenue growth was in line, company saw a worse than expected decline in its margin as it continues to now struggle against elevated employee costs and also its attrition level. Our managing editor Siddharth Zurabi spoke to N. Ganapathy Subramaniam, Chief Operating Officer and Executive Director of TCS, about company's performance in Q1, the recession fears and the way forward. Listen in to this excerpt of a special conversation. Take a look.
If we go sort of deeper into your results, it's clear that revenue growth has been in line with most expectations. There's a bit of I think, below expectations kind of view when it comes to margins and profits. What is the outlook on margins going forward? What do you see happening there, especially in light of higher attrition?
Yeah. So there are 2 or 3 points that I want to make on the margin front. In Q1, typically, we pay the salary hikes for all our employees, and we have got about 600,000 employees as at the end of the last quarter. And that has an impact of about 150 basis points in the margin front. That's the first point. The second thing is that as we have won a large number of contracts last year, the last quarter we clocked about $11.2 billion worth of total contract value. They all have to be executed, number one. And as we executed, we couldn't get some of our folks from India, who have work permits, etc. But we need to take the appointment from the embassies and travel. And they're all getting eased up, but still it takes about 4 to 6 weeks to get an appointment in the visa and the embassies, for example, which essentially meant that we had to start those projects with some temporary staff, subcontracting arrangements with the local consultants, etc. So on that front, the costs have gone up, and consequently, the subcontracting and lateral hire costs have gone up during this quarter. But it's only a question of a temporary basis. So all that means that they are all pretty much the levers with which we will also employ those levers to optimize our operations in the coming quarters. So as a management team, we feel confident and we are focused towards getting back to 25% margin fairly quickly, and then work in a way that we reach our preferred margin band as soon as possible.
Since we are talking about demand, and you had touched upon that earlier also, what is the latest feedback that you are getting? Because the R word, the recession word is up in the air. We really don't know how it will pan out. But what are clients telling you across geographies?
It's a good question. And I think, in the last quarter, we have met with a number of our customers. We could travel to UK, we could travel to Europe, and as well as North America. Several of our customers also visited our development centers in India, elsewhere. So we would have met about 30 plus client executives. And we also polled in a number of our own senior client base. All of them agree that they all note with certain amount of caution the macro headwinds that economists point out. But the overarching feedback that we have got is that, number one, is most of them believe that technology is important for their business. It has become a staple. And in that context, they are not thinking of, let's say, shrinking any of their technology budgets or anything that they have already committed to us. That's the first point. The second thing is that they all said that, look, they have got, at least, some of them openly told us that I've got 10,000 job openings. I've got 5,000 openings, positions across the globe, which needs to be filled up. So which creates a situation that I think that technology, there's a realization that the technology is important for their business resilience and they being able to participate in the growth environment that they see in their customer base, right? So all that meant that, look, on the ground, what we see is a continued demand for our products and services, a continued demand for technology talent, and the fact that, they're all in a multi-year transformation journey, which is probably halfway through. They don't want to stop and go after some time. They would like to continue and then complete the transformation programs, which is fundamental to their own business.
Mr. Subramaniam, I wanted to take another broad theme up, which you spoke about right at the start with regard to costs. That was an employee count of 600,000. And I've been asking this question of all IT leaders like you in the recent past. How's the hiring outlook from a broader Indian economy and the youth who are looking forward to employment? There's been a bit of a issue, but I think we are now well past the pandemic. How is the future looking like?
The future looks good. I think, the technology talent is very important. And anyone we come across when we visit the campuses, universities, or meet with youngsters, whether virtually or physically, we continue to lay emphasis on the demand for technology skills across the industry and across the globe, right? So we encourage them to take up technology work, and then, take up training programs, either in the field of artificial intelligence, analytics, data sciences, microelectronics. So we continue to motivate them to and share with them the areas where we see growth, where we see skill gap, right? So from that perspective, I think, from our own perspective, we have said that, look, we will have a hiring target of about 40,000 for this year, freshers from the colleges, which we have committed to, and then we will definitely onboard them, right?
What's happening to the rupee? How is that impacting, and what's your view as far as TCS is concerned?
I think rupee reaching about 79.80 was a bit unexpected, right? We thought that, we have had a fairly stable environment in about 74, 75. But then suddenly it hit 80. So which means it's actually, is it good for us, from that perspective. But then, rupee has also appreciated against other currencies, right? Whether it is a euro. And so there's a cross-currency headwind that we also see. Net, Forex will help in a kind of a situation where the employee costs are going up. It would help to neutralize some of this. But then, we should stay focused on the demand. We should stay focused on improving the pricing, improving the productivity, and other operational levers, which is what we typically do.
Since we started the conversation around your results, I have to close with a question that is related to shareholders. Overall markets, sentiment turning down and markets falling. IT stocks have also had a bit of a rough time. What's your message to your shareholders at this point of time?
We are in a good wicket, and I think the growth momentum continues. We are very confident of continuing our growth trajectory and end the year with a double-digit growth. And the contracts that we have signed is good. The overall talent situation is good and will ease up in the coming 2 quarters is what we hope and we believe so. So overall, it's a good environment to be operating in. We stay positive on the sector. We stay positive on our business and our clients' business.
That's all I have for now. Thank you so much for watching Business Today. Take care. You can always log on to indiatoday.in for all the latest.
Make your media plan smarter with India Today Live TV on your connected devices.
You are watching India Today.
I don't read the news. I read between the lines to tell you the true version of events, the true story of our times.
To document grief, the toughest assignment for any journalist to be.
From those who matter,
Women politicians going to stick up for each other.
Of those who should matter, I document the truth. I don't distort the truth. I don't glamorize the truth. I don't gloss over the truth.
The ghosts of India's contentious material history have come knocking again.
I hustle for the truth. On the ground, in the newsroom, in the studio. I don't try to grab eyeballs.
I inform you to make you see the point.
To the point with Preeti Chaudhary. At these times, only on India Today.
So sorry.
Me padlo. Adjust.
ए भाव थांबा. ए भाव थांबा. थांबा भाव. ए भाव थांबा. ए भाव थांबा. ए भाव.
मुंबईचा राजा कौन आहे?
मैं एकनाथ शिंदे. झुकेगा नहीं.
Presented by Berger Easy Clean. No dog, no dhabba, only beautiful walls.